Welcome back, everybody, to Volatility Trading Strategies. So we currently have 5 live short VXX trades that we're using for this running series, and so far it's going really well. The first video in this short volatility series was made right there, and the VXX has absolutely imploded since then. It's down over 20% in a few weeks. Now, this is not overly surprising. It's actually exactly like we expected. Remember, in video 1, we did calculate the long-term decay factor of VXX, and it is strongly negative. This series is a great example of why I've personally been shorting volatility now for about 15 years. Now, side note, a lot of people do say that to get clicks on Twitter, but can they prove it? Here's a few of my VXX trades way back in 2010, just shortly after it launched. I was one of the first people trading this thing, and I was definitely one of the first with a public portfolio where people could follow along with my live trades. And of course, my flagship strategy, just straight up shorting volatility using the VIX index. Here's 2011 for just my VIX options trades, which is a strategy that's been live for over 12 years now. I'll be putting together a full course teaching it to you very soon, so stay tuned for that. But obviously I've been at this for a very long time, and there's no question that being on the short volatility side of things is the right side. The problem is it's not free money, it's actually quite dangerous. And most people who try to short it will unfortunately blow up their account. I make all these videos to make sure that you won't be one of them. Today's video is an extremely important aspect of the short vol trade, and it has to do with speed. How fast are you expecting volatility to decline? If it happens quickly versus slowly, the trade structure you choose can make or break your success. Let me show you what I mean by that. Now, there's dozens of ways to short volatility, of course. Making videos, of course, I do have to narrow that down a little bit, so I chose 5 different methods for comparison. So let's start with a baseline trade, which is just a straight up short VXX position. That's this one here. So remember, we opened all these trades when the VXX was right about here at $35.50. And over here, this is that $25 mark. This is where we calculated the VXX is going to be near expiration of our trade cycle. That's video 1 of this series. I'll leave a link here if you want to know exactly how we calculated that level. But here's the VXX right now, and clearly it's decayed quite a bit. Now remember, I don't ever short the volatility ETPs directly. The risk is just too high. There might be a flash crash in the future. I don't want to do anything stupid. So in that video, we opened a long SVIX position instead. That's this trade right here. It's also doing very well. It's actually up a little bit more than the short VXX is. But for this video comparison, we are going to highlight the short VXX position. All right, so we tried to scale all the trades to about $1,000. This short VXX position is up $214 right now. The second trade that we did is this one. This is a long put option on the VXX. And this trade is up $868 right now. It's getting pretty close to doubling in value in just a few weeks. The third trade we did is here. This one is a long put vertical option. Also doing well. This one's up $422. The fourth trade is a personal favorite of mine, of course. I talk about these quite a bit. This is a long put butterfly option. Now we can see this one is only up $40. Now I say only, that's actually a 4% profit in just a few weeks. It's still good, but not even close to the other ones, right? Again, speed matters, which we'll dive into in a second. But the fifth trade we're comparing to here is a naked short straddle option. This one right there. Now it says it's up $288, but if you remember from those earlier videos, this trade isn't possible to scale to $1,000 of capital because one single contract required over $5,000 of margin. It's a naked option, super capital inefficient, so we have to divide this by 5. It's actually up about $58 if we scale them the same. So what we've got here are 5 different ways to short the VXX and 5 different levels of profit so far. I've scaled and adjusted all of these using $1,000 of capital so we can compare apples to apples. We've got a current profit range from $40 for the butterfly all the way up to $868 for the long put option. And what we want to compare here is what speed of the VXX decline is actually best for each different short volatility method, because they are very different. So starting with just a straight up short VXX, we can see speed doesn't really matter much. It's up $216, and if the VXX is at the same price it is now at expiry, it'll still be up the same $216. Now remember, there are fees to borrow, but I'm not going to include those here. Now, if the VXX does expire where we are expecting it to, around 25, this trade will make a little bit more. It'll be about $284. And then something that all traders have to consider every single time you are shorting volatility: what happens if you get caught in a volatility spike? Now, I'm not going to use a crazy one here. Remember, the VXX can actually spike 500, maybe 1,000%, depending on the magnitude of the crisis. But I'm just going to use a double from the day we opened it and say $70. Well, this trade would lose about $930. So we can see for a direct short VXX position, the speed of the decline doesn't really matter. This is just a one-to-one method of shorting volatility. Short VXX is pretty easy to understand. Speed doesn't matter. But now let's get into a trade where speed of the decline is what matters most, and that's the long put option. It's highly profitable now, but let's go through all the same comparisons. Here's our long VXX put option, and it's up $866. It's nearly doubled so far. Side note, these might be changing a little bit. Of course, markets move around. But what happens if the VXX actually expires at the current price? Well, this trade would suffer a full loss of the capital. You could go from being up nearly double your money to losing all of your money if the VXX just stays where it is now. And what about if we get our prediction of $25 at expiration correct? Well, this put option would still lose $543. Imagine that. If we get our prediction exactly right, we'd still lose half our money. And then again, of course, the Volapocalypse check. What happens if it goes to 70? Well, of course, it loses the entire amount of capital. So for long put options, the speed of the decline in VXX is highly relevant. You can get a hugely profitable trade if VXX goes down quickly like it has the past few weeks. Or you can get a total loss of capital if the decline happens slowly. There is no trade structure that is more sensitive to the speed of price change than a long put option. You basically have to nail your prediction perfectly to make money. Now, the next trade we'll look at is a long put vertical option. This is the trade here, and so far it's up $421. It's doing great as well. But this trade is different than a long put option, right? This trade is a long 29 strike put option, but it also sells a short 24 strike put further out of the money. This significantly reduces that headwind. It means if the VXX expired where it is currently right now, it wouldn't be a full loss. More importantly, if we do nail our prediction of $25 correctly, this trade would actually make a nice profit. $683 on capital of $920, it's about a 73% profit. Now, if VXX spikes, of course, no surprise here, this trade also loses the entire amount. So the long put vertical, much like the long put option, it also requires speed of decline in order to maximize profit. But there is a difference here. If it happens slowly and does eventually get close to the price prediction, well, the long put vertical still will be profitable, but the long put option won't be. Those ones still need the VXX to go down fast and then just keep going. So if you were to ask me straight up which one of those is better, I don't think there's any question. Long put verticals in the vast majority of cases are superior to long put options. Less sensitive to speed and much easier to make money with. The fourth trade, like I said, is one of my personal favorites, and this is a very interesting trade. A long put butterfly on VXX. So this trade is only up $40 right now. It's lagging way behind the others. However, this trade can really turn into something great if you give them some time. This is the current live VXX butterfly. Up $40, not a whole lot happening right now, but let's go through the same comparisons. If VXX expires where it is right now, this trade would make $2,200. That's more than double the $1,000 it cost to open it. And then what if we get our price prediction right? If VXX gets to 25 at expiration, this trade can now make over $5,000. This is a crazy skewed risk-reward profile. How many trades do you know of that if the VXX does exactly what it has already done since it launched in 2009, and it decays at its normal long-term rate, it's a trade that can make as much as 5 times the capital? Now, obviously, you're not going to nail it perfectly, but what if you start layering a bunch of smaller trades, spread out over many different expiration cycles going forward, capitalizing on the very well-known and expected decay factor of these volatility products? This is exactly what we do in our volatility trend strategy at VTS, by the way. Claim your free trial if you want to access all of those VXX and UVXY butterfly trades, as well as the entire VTS portfolio. But we can see the speed in this case of VXX butterflies is labeled slow. It means we have to give these trades some time to develop. They do need to get closer to expiration. But when they do, that's when you can start to get some explosive growth of the option value. When I trade butterflies, I keep them small, and then I don't even really look at them until they get closer to expiration. You really do make your profit off the slow passage of time here. And then the last trade we'll look at, again, very different than the previous ones. This is a naked short VXX straddle. Now again, all the same warnings apply here. Naked options, super high risk, very capital inefficient. Just don't do it. But here's our naked VXX straddle, and here's the price right here. Now remember, we have to divide these numbers by 5 because this trade is 5 times larger than all the other ones. There's that capital inefficiency for you, but right now it's up $288. Divide by 5, that's 58 bucks. Again, not much happening here so far. This is another trade that requires us to get closer to expiration. Now the problem here is, even if you nail your price prediction perfectly and it expires at the exact peak, we're still looking at just $16.60. Divided by 5, that's $332. Remember, the butterfly will make over $5,000 if it expires at its peak. So which one would you rather have? A defined risk butterfly option that can make as much as $5,000 and only lose $1,000? Or a naked straddle option with unlimited loss potential that can only make $332? Come on, what are we talking about here? So the speed that maximizes the short straddle option profit is again slow. These also need to be held close to expiration in order to make any serious profit. So now comparing all 5 of these quite different methods of shorting the VXX, if the speed of the decline happens quickly, then there's no question the long put option will be the winner, followed by the long put vertical. Both of these trades are highly sensitive to speed. To be honest, if it wasn't a video series where I wanted to keep the trades open for a while, I would have already closed out the long put option. It's done its job, and the longer it's held open for, the more likely it is to just lose all of the money. Get in, get your profit, and get out, because these trades do just decline over time. As we showed, speed doesn't really matter when shorting the VXX directly. This is the only neutral trade because it is just a 1-to-1 position. VXX goes up or down $1, you make or lose $1. The long butterfly and short straddle are both optimized when they are allowed to get very close to expiration. Slow bleed of time is how these trades make money. But therein lies the problem. One of these trades, the butterfly, you can still sleep comfortably at night. You know your maximum loss. The straddle, on the other hand, you're going to have nightmares every night about the dreaded flash crash or cyber attack. And not to be too doom and gloom here, but it is going to happen eventually. You have to factor that in. I know I don't want to be holding undefined risk, and I would recommend that you don't either. Plus, undefined risk isn't even that profitable even if you get your predictions right. Look at the vast difference between these two trades. It isn't even close in my opinion. So not only do you have to understand how the volatility ETPs actually work, what causes their decay factor, and how much that decay is, but you also have to pick the right trade structure to match your specific goals. Your own risk tolerance that fits in with your overall portfolio. This short volatility game, it's really not easy. I showed you with my broker statements at the beginning of the video, I've been at this a really long time. If you do want some guidance and access to all of my live trades, of course, claim your free trial to VTS. It's available to everybody, and if you have done it in the past, go ahead and sign up again. Let's all try to safely capitalize on the inevitable decline of these products. See you next time. So for an extensive volatility metrics dashboard updated daily, and to see all of the live trades for our tactical rotation and option strategies, click this link right here and claim your free trial to the VTS community. You're always welcome to join us anytime. See you next time.